Welcome to The Derivative by RCM Alternatives. Send it. All right, everybody, got me here a little bit in the dark for those of you seeing me on YouTube. But welcome back. Hard to believe we've gone and started a war in the few short days between our last episode and this one. But here we are with drones flying and bombs dropping. We actually had the head of a defense tech company, venture capital firm that invests in defense tech, scheduled to come on the pod later this year. So went ahead, reached out, and going to have him come on next week. Talk about modern warfare like drones and anti-drone tech and all the rest. So tune in for that one. We also put up a new post after seeing the somewhat odd market movement Monday after the weekend's conflict began. It was a little bit odd. Oil was up, stocks down as you would expect, but bonds weren't up all that much in the beginning and reversed hard by the end of the day with higher rates and bonds down, which is not what you typically see in a flight to safety war positioning. So is it just a case of buy the rumor, sell the fact? Probably, but we wrote a little post on that. So head on over to rcmalts.com. Check out our short history of Middle East market moves. Okay, on to this episode. We got a good one for you today, talking with Patrick Kazley of OneRiver. Patrick and I are both card-carrying members of the trend following and long vol clubs. I don't quite have my card here in my desk, but trust me on that one. So it was fun to bounce thoughts off one another here on this episode. And also, as we talk about risk mitigation strategies are top of mind, given what's happening. So we could have gone at least 5 hours on this one, but managed to keep it just a little bit long and not crazy long. So grab some soup. Yep, soup. You'll get that reference towards the end as we explore what Patrick and me to a lesser extent have been saying for a while now, which is, can you really rely on bonds for risk mitigation? Maybe it's time to add a few more tools to that toolbox. Send it. All right, everybody. We're here with Patrick Kazley of OneRiver. Patrick, how are you?
I'm good. Jeff, how are you?
Good. Is this a home office or an office office? Looks lovely.
Yeah, this is the home setup. Got better lighting, better audio visual over here, but no, yeah, it looks a little bit like one of those pre-canned offices, but this is actually my house. Yeah,
I love it. Where are you located?
well, our offices are in Connecticut, Stamford, Connecticut, and I live a grueling 8-minute commute away from the office, so not a bad situation. Yeah.
Do you get a little? It's like Connecticut hedge fund. It's like very cliche. Do you get a little like, okay, why are we here? Or it's just like, no, it's cliche because you have a lot of talent and you have a lot of access and all that.
Yeah, that's what I mean. We started OneRiver. Eric Peters started OneRiver in Santa Barbara. So the talent pool was there. Actually, we grabbed our current deputy CIO, head of quant, from Caltech, PhD, academia, and then he was at Credit Suisse, but joined us. So the West Coast has started as a decent talent pool, but as we scaled, all the talent rushed to New York area. And neither Eric nor I are massive fans of living in the city. So we like the trees, we like the open space, and Connecticut's great. So yeah, when I was I started my hedge fund career at AQR in Greenwich, but then spent 4.5, 5 years in Asia. So I had at least I got some non-usual geography in there before rushing back to the homeland, Fairfield County.
Where in Asia were you?
I did a little bit of, so I was in Hong Kong for the better part of 4 years and then half a year in Japan. Opened up both those offices. Kind of got to arm wrestle with the great sovereign wealth funds of Asia and learn how they think about the world. It's pretty formative. And when I came back to the States with AQR, pretty shortly thereafter, got in touch with Eric Peters at OneRiver and we started chatting, saw the world in a very similar way. So then I found myself here.
I'm going to dig into OneRiver's massive footprint, but before that, just any Cliff Asness thoughts? Is he as crazy in person as he seems to be at times online? Loves to pick a fight on Twitter.
You know, Twitter was
crazy in a good way. Like,
Twitter was a nascent kind of development when I was there. It was, especially towards the end, it started to heat up a little bit and that he was a bit more active, but it was always a marketing tool because, while he's always engaged and at times, I think, charmingly bombastic, he has a pesky tendency to be overwhelmingly right. Um, and
Yeah.
so that always, well, it could be viewed as a distraction at some level. It was always fun to see him actually have some pretty cool engagements with meaningful people that probably wouldn't have had the opportunity to have that publicly aired. Net, it ended up being a marketing benefit. But no, yeah, he's a fun character. It was a pleasure to work underneath him and the team. But that's kind of where that's kind of where I cut my teeth. Learned the basics of quant investing as well as the non basics, and then joined a long vol risk mitigation shop. Totally different mission than a place like AQR.
Uh, right. So One River, give us the 30,000-foot view, and then we'll dig into your smaller purview,
Yeah,
although by no
we've been
small.
around since 2013, as I mentioned, founded by Eric Peters, but I serve as its president, head of solutions, primarily working with some of the larger institutional investors globally. But the day in day out of what we do is primarily systematic risk mitigation focused. The mission of the firm is pretty easy. We want to make their portfolios better, and we do that by acknowledging what the predominant risk in their portfolios is. It's usually some form of equity beta. And then we build building blocks, active strategies that effectively lean against that and protect that pool of capital. So that lends us really well to systematic expressions of long volatility, trend following, increasingly getting into systematic macro. But the heart of what we do and what we're best known for, systematic long volatility, defensively oriented, highly convex, negatively correlated strategies.
And you would think, right? You view that as unique, right? Of like, hey, we're systematically looking at risk mitigation to make a portfolio better when it seems obvious. I mean, we're both drinking from the same Kool-Aid here, right? So it seems obvious to me. And most of our listeners probably are like, of course, that makes a portfolio better. What are you talking about? But 12 years ago, whatever, when you started, and even now, like how much of a aha moment is that for institutional investors of like, okay, I actually need to look at that side of the ledger instead of just always trying to make my portfolio better by adding VC, adding real estate, adding lumber, whatever.
Yeah, I think it really goes back to those Asian sovereign wealth fund days where, I always call those big allocators aircraft carrier allocators because they can see something on the horizon, but they're way too big and have way too much mass to really turn and avoid it. Right. So they have to do pre-planning before they can really change their stripes. And so convexity defensive strategies were always really appealing because it was something they could hold on to that would potentially save their tail, pun intended, if something were to manifest. And but ultimately it does fly in the face of modern portfolio theory. In other words, if you're buying something that's protective, it's viewed as a form of insurance. Buyers of insurance tend to pay sellers of insurance over the long term, and you see this pesky term, it's so painful that they call it a bleed, a negative average return that can manifest from defending yourself. We've written a host of white papers over the last couple of years, and I've contributed to a lot of, I'd say, the industry thought on this, but we challenge that conclusion. In other words, we show that you can effectively hold your equities, that you can protect yourself at the same time, and you can have a total portfolio that has a better compounded return. And the metaphor we overuse, as you know, is something like the F1 car, with the equity beta is a really good engine and convexity is a really good set of brakes. If you attribute time to the brakes at the end of the race, it's going to slow you down. But ultimately, you should be driving faster if you have a good set of brakes. And so the F1 car that wins the race may really have a similar engine to its peers, but a better set of brakes. And so we have systematic brakes that we can install on these client portfolios, and we usually help them drive faster too. So oftentimes we'll put offense and defense into these portfolios, but the objective is actually really simple. We want to generate superior compounded returns. And the reason that mission, as you mentioned, is, I'd say, unique is that the hedge fund industry and I'd say allocators and mass have a natural addiction to average returns and high frequency average returns, even if they're low magnitude. And that will tend to draw capital towards high average return, but negatively skewed assets. Equities being the prototypical example, but most hedge fund strategies will have a similar profile where you make a little bit of money very often. And then when you lose money, you lose way more than you typically would make. But you can still carry positively through that, but it's a negatively skewed endeavor. We're the opposite. We have a very low average return until something that we're betting on manifests at a low frequency, but an extremely high magnitude, right? Kind of unsurprisingly, A plus B could yield something that is a compound return that's greater than the sum of the parts. And that's what we generally observe. The math there is well studied, well established, and I think even well agreed to. What I really like about the space is that despite consensus on the math and the academics behind it, there's just not a lot of capital pursuing that type of strategy. And a lot of it goes back to behavioral and governance reasons, meaning investors often get paid on their average return outcomes. And so they tend to eschew active ingredients that don't pay frequently. And so that
And talk
leaves, yeah.
and by average return, are we talking volatility? Like, explain a little bit more what you mean there. Just like if I have, because if they have an average return of 1% a year or something, maybe
Yes.
that's not exciting. But you're talking a little more. We can get into Cliff calling it volatility laundering too. But sorry. So what do you mean by average return of what they're targeting?
Yeah. So if you had let's say you found this amazing strategy that was just a money printing machine and it made 10 basis points a day, like clockwork. Okay. Every single day, 252 trading days a year, it makes 25%. If you were to sum that up a little bit more, and the geometric compound return is 28, 29% on that return stream. But let's say instead on the last day of the year, instead of being up 10 basis points, it's down 25%. Well, now your average return is 0, but your compound return is negative 5-ish percent. Right. And so what happened there was that even though you had what looked to be a very attractive average return, there was this hidden negative skew factor that when it manifested just completely destroyed your compound return. And so the siren song is to backtest strategies that have that type of high average return, meaning they pay you frequently and at a decent clip. In this case, I used an extreme example of something that pays you in a monotonic
Daily.
fashion 25% per year. But if you're unbounded to the downside, and there's a rush to the exits, say it's a levered spread strategy, you could have years of that return wiped out in a moment. And equities directionally follow that in that they tend to lose money reflexively, not that extremely, but it's generally true. So if you can find things that are positively skewed and have the other opposite negatively correlated return stream to that, you could do really well.
Basically, negative skews option selling, positive skew option buying.
Mhm.
There's nuance to that metaphor, but
Mhm.
I've sometimes said like, hey, would you, when people are like, hey, the Powerball's at XYZ, I'm like, would you play it in reverse? Right? If someone's like, you go into the mini mart every day and they give you $5 every day, but
Mhm.
some unknown point in the future, and maybe like 1,000 years in the future, your heirs owe $6 billion, right? And it wipes out everything you've ever owned and all your stuff. So would you play that game? Because essentially that's what we're talking about, right? Like they're like collecting with this unknown time and magnitude event in the future. But I was in that example, they're equal, right? It's like the mathematical expectation is equal,
Yeah.
which nobody gets. Like, oh, I'm just spending this $5 to get this 6 billion.
Yeah.
Like, yeah, but if you play it over enough thousands of years, you're going to lose 6 billion.
And I
So how do
think,
you view that of like
yeah.
long term? Are they terminally break even, both sides of that equation, or you think the math works a little better in one way or the other?
Well, I think investors tend, especially allocators, I think you're going to tend to have a better psychological journey if you pursue the high average return route, right? Because the reality is, when you fail, you'll fail conventionally. So
Mm.
the example would be just buying, a high growth stock portfolio. And eventually, you don't know, but you suspect, and you're probably right, that you're going to get bitten pretty hard on that. It's going to really impact compounded returns for a long period of time. But you're in good company because everybody else has been making. So that conventional choice makes it a smart choice, because the worst thing you could do is fail unconventionally, right? So if you take the other side of that bet, and let's say you build in sufficient asymmetry, you'd end up in the same place. Well, now you have the opposite problem. When everybody else is making money hand over fist, you're massively underperforming because you took the positive skew side of that trade. Now, the question is, can you passively harvest that equity risk premium and then actively defend yourself? And that's what we recommend you do. So that way, in the
Yeah,
benign
don't make
years,
the choice. It's a false choice. Like,
yeah,
do
it's a
both.
false choice. Yeah. And the reason you can do that is these things are very capital efficient. You can you don't have to chew up your whole balance sheet to defend yourself. It's a very small outlay. And that's kind of that use of derivatives and prudent use of leverage is basically a way of keeping up with the Joneses when the average return environment's high. And then when the wheels fall off the bus, you have this hidden source of convexity that manifests and makes you look really good relative to peers. So that's back to the F1 car. You should drive faster such that whatever that cost of the insurance policy is, you're effectively making up for it in additional equity exposure.
Which has been put to the test, right? Like, how far would you take that? Right. So you're saying I can go faster into the curves because I have better brakes, basically, and I won't fly off and wreck, which I love that one. So how far can you take that? You're like 98 to, right? Like a universe is going to say put 98% in equities, 2% tail,
Sure.
and you're good. Some are even going 110 or something like that, right? So how far would you take that metaphor of like it allows you to increase the offense, increase the speed?
What we would say is identify for your given style of defensive investing what the benign market beta is. The benign market beta. So if we're running this long volatility strategy, we would be able to use any number of pretty simple techniques to determine, hey, we have a negative zero point 0.2 beta or a negative 0.3 beta. And with the understanding that that will really expand in a crisis, but that's a good thing, right? But we say no, that theta bleed or that negative average return that we typically observe is really just a negative market bet and some residual, okay, long term.
Yeah.
So let's calculate
Like
what
you
we think.
sold down some of your position.
Yeah, right.
Yeah.
And so if you were to just buy that defensive return stream, well, not only do you take on that negative average return, but you also forewent beta. Okay. So what we would say is put on that defensive exposure and put on a requisite amount of long equity exposure to offset the benign market bleed. So if you determine that a given source of long volatility has, say, a minus 0.2 beta, well, then put on a 20% exposure to an equity future and put on a full exposure to convexity. So at the total portfolio level, if you wanted to be maximally, if you really wanted to abide by the F1 car principles, you would say I'm 120% exposed to the MSCI world and I'm 100% exposed to this long volatility return stream. The most important thing is that you do those together because when you do it together, I mean, inside one pool of capital, now you can rebalance over time, right? And that's the magic. So if you take something like the Eureka Hedge Long Vol, we can avoid specific mentioning of products, but we can take the Eureka Hedge Long Vol, which is a pure composite of net of fee convex returns, and you can pluck a constituent out of there that's up 40% on the year of 2020. Okay. And let's say at the end of Q1, it's up 45%. Okay. And then you look at the S&P, it was up 18% at the end of 2020. By the end of Q1, let's call it down 30. Now, let's say you're doing this kind of structure. You're fully long equities and you're fully long this long vol manager at the same time. Well, at the end of Q1, sleeve one is down 30. That's the equities. Sleeve two is up 45. So you're up net at roughly 15%. Okay. Well, if you did that together in a derivatives portfolio, your NAV just went from $100 to 115. But now what you can do is you can resize the sleeves to $115 net asset value. In other words, you can increase your equity exposure to $115 and you can reduce the size of your convexity bet from 145 to 115 as well, taking chips off the table. And then the market recovers really strongly, 40+% bounce. Your long vol process almost certainly is going to give some of it back, but hopefully not too much if it's doing a good job. And at the end of the year, the arithmetic, if you were to just sum up the sleeves, you have 40% from long vol, you have 18% from equities. You would think you'd be up 58%, but the compound return of that rebalanced portfolio is closer to 82%. And so that difference, and you didn't have to subscribe new capital or come up with new cash. You just leveraged the principles of negative correlation, positive convexity, capital efficiency, and rebalancing. And so, what we do is
essentially did a bit of timing, right? Like the rebalancing forced you into a timing advantage there, timing alpha.
Yeah. And we wrote another piece called the Convexity Rebalancing Act. And it's all about how cute do you have to be.
Gotten through Congress yet?
Yeah.
It's an act? Yeah.
That's right. Yeah. But kind of much like an act of Congress, it's highly contested as to how you should do it. Right. We always tell people the irony of buying long vol is that you're no longer stressed about how much money you're losing. Now you're stressed about when you're going to pull the plug.
Yeah.
Right. It becomes this, and everybody thinks ex ante that the smart thing to do is going to be when I'm at my peak pain point, I'll pull the plug on my convexity and buy cheap equities. I'll do the contrarian thing and I'll do it aggressively. And it feels great. But the reality is people's pain points famously don't come at the right time, meaning they're pulling the plug, say, at the end of February 2020 or
Yeah.
versus mid-March 2020. And what that does is basically if you have we call it a threshold-based rebalance, where you're picking a threshold, equities are down this, or my hedge is up this, and I'm going to pull the plug. When you do that, you create a very path-dependent outcome. Now you
And what's
locked in
that based
things.
on? You watching the news or your emotions? Yeah.
Right.
Or are you saying like an actual percent down?
Yeah, we've had clients do, hey, when markets are down, a rolling 3 sigma event over a 2-year horizon, if they're being more sophisticated or if they're being simplistic, they're saying equity down 20, cut the hedge in half, equity down 40, empty the hedge. Okay.
Yeah.
Because maybe the equities are going down to 55 in a GFC, but it's good enough. Okay. We actually don't recommend doing that. We don't recommend doing that because it ends up doing really well in some crises and really poorly in others. And oftentimes, the worst thing that can happen is you race right up to your threshold and you don't hit it,
Yeah.
and then you end up having a really bad compounded return when you could have had a really great one. So what we do instead is a time-based rebalancing, and a little bit all the time works way better than any of these threshold-based programs. Now, to
Hmm.
be clear, in any one crisis, the best threshold will be the best option. But the
Yeah.
reality is the relationship between, if I'm
Right.
speaking
Down 49.76%. Like how come you didn't have that in your model?
right, and the relationship in quant parlance, the relationship between parameter selection and outcomes is random. In other words, it's a really hard model to get right. But if you do a time-based rebalancing, you don't have to get it that right. In other words, you could do it every month, every quarter. We do something that we just want to maximize path independence. So, in production, we'll do something like every week we'll rebalance a quarter of the portfolio, such that every month we've done a full rebalance. But now we're not overly reliant on certain calendar effects. And we run those two sleeves together, equities and long ball, and we let the compounding do the work. So for us, then we remove the stress of when to pull the plug, and we're focused more on just doing well in that long ball
Hmm.
trade.
And that's singular, that stands on its own. So it's not like if you're 100x your premium you paid or something, like, is that built into some of the models as well?
Yeah, the way that we structure it is more of a traditional alternative line item. So instead of having it be some sort of premium spend approach, the
Yeah.
issue with those types of approaches is that while it feels good as an investor to shuffle up premium like an insurance policy, the geometric return, the compounded return of that line item tends to not favor very well. You have these prints that look really great. Oh, you're up 3,000%. And if you were to
Yeah.
normalize our returns using outstanding premium, you'd get similar returns. But if you were to actually look at the
We'd be
use of
down
capital and the
100% every
compounded
other year.
return, it would be way less impressive. So we actually present our returns in the accurate format, I would say, in that we have a compounded return that can be compared to any hedge fund or any holding in your portfolio. So yeah, investors would subscribe into an AUM or buy an SMA with a trading level. And yes, that fund could hold the equities and the long ball. Many clients just hire us to do the long ball. They handle the equities on their own.
Yeah. Have you guys done work like part of the rebalancing, right? All the math, all the papers looks great. In lived experience, you go through these periods where equities have these steady, consistent runs and it feels terrible, right? Because you're taking those chips off the table, you're ruining your equity compounding in a way. And so you need those like periodic episodes to be able to get that rebalancing and be able to compound higher. So do you guys have math or just how do you think about it generally of when rebalancing doesn't work?
Yeah, rebalancing will have its toughest episodes in the scenario you mentioned, if and only if you haven't properly neutralized that negative carry.
Mm,
So the example you mentioned, like a 2017, equities were up every single month. Really tough time to be long ball. No hiccups. But if you look at if you've accurately determined what the bleed of your portfolio should be, well, then you will have the requisite amount of extra equity exposure to make up for that. And so
Mm.
if you've reached construction nirvana here, you really shouldn't care where the return comes from, the extra equity exposure or the insurance policy. If you are overly concerned about that, then yes, you're going to set yourself up for frustrating evaluations because it's entirely possible over a multi-year period. In fact, it's probable over a multi-year period that one side or the other will dominate. It's very unlikely you're going to equal contribution to return from both.
Yeah, definitely. And said in my view of like, it's very unlikely you're going to have that perfectly timed period where the rebalancing worked out.
Yeah, 2020 is an
Um,
exception to that, where you're like, well, equities are up 18 and the tail hedge is up 40, and everybody
yeah.
looks smart. That's kind of, I mean, if 2017 is a tail hedger's nightmare, then 2020 is, a dream. And so the worse it is for the world, generally, the better it is for the strategy. That's by construction. But ultimately, we try to put our portfolios in a place where we and our clients do not care where the return comes from, as
And
long as
then,
it out compounds equities over the long term.
and then the two 1720, also 22 was a risk responder's dream slash nightmare. Right. So the long vol components weren't working. Equities were also down.
Yeah.
So that's the flip side of that equation, right? If you're 120, 100,
Yeah.
that's very painful.
It is. And that's, you mentioned risk responders. That's what we call this framework where you combine a tail hedge or long vol approach with something like a systematic macro, a trend following process. What we really like about trend following is its long reflexivity. So if you get this kind of orderly rush to the exits, so not like a panicked rush to the exits where you get an expansion of vol and long vol approaches should compensate you. You get this kind of orderly march to the exits, kind of famously like a rolling put portfolio in 22 lost something like 18%. Is basically in line with the markets. Um,
Yeah.
Now, our long ball process was down far less than that, but trend had its best year in a decade,
Yeah.
more than a decade. And so, the rationale, and trend is a category, including our trend, right? The rationale for why trend does well there is the exact reason for why it's such a tough period for equity vol. So that's why long vol and trend. So to summarize, I think convexity is a bit like the fast twitch muscle to respond concurrently to a crisis as it's unfolding. Trend is this slow twitch muscle that, by the nature of how those algorithms work, it's going to do better over prolonged declines. So if you do both, you can have that immediate response and that slow response, and you can actually have a much more robust kind of fishnet of risk mitigation. You can lean both of those against equities. We do that. In fact, it's such a holistic solution. We literally call it the total portfolio strategy, because you have the total portfolio of the equity risk. You have this fast twitch muscle of convexity and the slow twitch muscle of trend. And that 1, 2, 3 punch kind of leads to, again, if we do that well, you shouldn't really care where the return comes from. You just have a pretty high degree of confidence, very long term, you're going to out compound equities.
In that scenario, like we can't cover every scenario, right? Like, okay, do you have CDS and you should have crypto in case all the currencies go away and yada, 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 right? You could think of 1,000 different pieces of convexity to add to the portfolio. So kind of how do you draw the line and be like, we've got enough here, we're good?
Yeah, you generally have to pick your battles here. So we try to protect something. We picked equities because it's the predominant risk in any institutional large pool of capital, which is where our clients are focused. So whether you have a 60% weight or 90% weight, you probably have a risk contribution coming from beta that is somewhere between 70 to 95% if you're a institutional investor. That's a typical contribution to risk coming from equity beta. So the predominant risk in the portfolio is that equities don't compound well. So that's different than saying equities don't return well. I was saying that they forego
Hmm.
compounding. So if you are to forego compounding, you need to either A, have a big drop and stay down, or B, you need to spend a really long period of time not going up. The kind of crises that we care the most about are the massive reflexive declines like 87 GFC COVID, the prolonged declines like 2022 or the tech bubble, and then the mini chaotic declines like August 2015, February 2018. Those are impactful too because, or the U.S. debt downgrade. Those are kind of the gut punches along the way where you don't get that immediate bounce back to high watermark and you stay low for a while. Um,
And
But
you don't know in real time whether it's the start of a GFC or it, right?
right. And you also don't know if it might just immediately resolve itself. And that's the fourth type of crisis that we care less about. So the V-shaped decline. So to your question about picking battles, the battle that we pick is the type of crises where you forego the most long-term compounding, which means that we tend to focus a bit less on the type of crises where you don't forego compounding. So a V-shaped decline is something like a tariff tantrum of this year. That was very short order. We saw markets could be about 17% below their high water mark on the month of April up until the 8th or ninth, which ninth was the policy capitulation day.
The
We
launch
saw,
of the taco
yeah, the
trade.
taco trade kind of manifested. But before that, if you were to look at like a long ball process like ours, we were doing exactly what you would have thought. We were up more than the market was down, and that convexity factor was growing at a growing rate. And so the risk reward was really attractive. We were saying, hey, the market's down 10% in the month, we're up 12% in the month, and we're realistically we're risking 9% to make 30, 40. And I really like that risk reward. Now, of course, what happened on the ninth is that the left tail for our process manifested, the right tail for equities manifested. And so we gave up the majority of that accrued return. But that's okay in the context of what our mission is, which is because equities were down 80 bips on the month, and we were back through high watermark for equities in very short order. So there was no foregone compounding. And so our process preserved capital. We made a little bit, but we're happy to run the risk of giving back accrued gains if it means that we can stay in the fight if that were to turn into something much worse. So, yeah, you have to pick your battles. I'd say deprioritizing V-shaped declines without giving up on them. There are ways to capture those, and we're getting better at that as a matter of research. But if you try to do too much of the V-shape, then what's going to happen is you get that big reflexive crisis, and markets are down 50%, and you're only up 20. And that's
You've monetized too quickly, essentially.
Yeah, preemptively, right.
And then how do you, right, my friend Jason Buck and the cockroach, he's always talking about nobody's thinking about the second leg down.
Yeah.
Like most risk responders, everything's just put in place for the first leg down.
Yep.
So how do you guys think of that? It seems like you're on board with that, with what we're just saying. Like, hey, we're not trying to protect against that 10% move. It's a 40% move.
Yeah, we actually wrote a paper. It was Good Trends Come to Those Who Wait. And it was exactly that. We examined the responsiveness of both convexity and trend in the first 10% of a decline, and then looked at it 10 afterwards, and very different charts. In fact, something like a trend following program is a little bit better than a coin flip historically in a 10% decline in terms of being up or down. And then in the next 10% or even any percentage beyond 10% decline for equities, it has an incredibly high hit rate. And so, yes, it may take a while for the chameleon to change its stripes, but in the time of greatest need, it's very reliable. And that's how we model our process. So, by the way, easier said than done, because at the end of April, if you're an allocator who bought a tail hedge or a trend following portfolio for defensive reasons, and everybody feels like the world just went through this big tumultuous event, and you look at the returns, for the long vol, you're up a little. And for a trend portfolio, the category was down a lot, right?
Yeah.
Very frustrating. And you can walk through everything I just said and everybody can understand it. But then it gets to the next layer of the board and it may not meet favorable scrutiny, just because it is a nuanced story. This is all part of the behavioral bias that I think makes the margin for these returns very wide, meaning there's just not a lot of capital that's going to be competing to express these types of strategies because of the frustration with the frequency of returns.
And talk a little bit, like that lived experience in April for the trend followers was brutal, and thereafter, right? It lasted through June or July. What does that do to the math of like, okay, this was a non-event, it was this V-shape that we're not trying to cover, but actually we experienced these big losses on that piece of it. So just talk through that a little bit. Like that seems like more you're realizing negative carry in that scenario.
Yeah. And I think we wrote about that as well in terms of when we observe the largest drawdowns for trend, and then if we examine the subsequent periods following those largest drawdowns, we tend to see that the average and median outcomes following the biggest drawdowns are well above the full sample average and median outcomes. In other words, trend tends to bounce. Okay, so why does trend as a category tend to bounce? It's not like trend gets cheap. It's not a stock. So
Right.
there's no there's no immediately obvious risk-based rationale for why a trend following strategy should bounce. But, I would propose the following for why trend tends to bounce. If you have
Yeah, I
a
was going to
period,
say
so
call on me,
yeah,
but no, go ahead. I'll let you start.
the for me, it's when you look at the worst case scenario for trend, it would be something like in April. And if you look at what April was, it was a manufactured period of whipsaw, meaning there was a series of policy choices and prescriptions that if their intention was to be anti-trend, they couldn't have done a much better job. And and so when you get that, it's a distortion on prices, meaning it's an anti-trend hypermean reversionary force. And when you get distorted forces like that in markets and they achieve their goal of maybe foregoing some sort of acute liquidity crisis, et cetera, and that gets removed, and you go back to quote unquote normal dynamics, well, then the market has to kind of snap back to what it was planning on doing the whole time, right? And that's across all assets. And so basically, any sort of really acute period of losses for a trend following program tend to be followed by really strong periods because that distortive force is eventually lifted. And then it tends to, you get the snapback in the trends that were already forming. And trend tends to be, by definition, pointing in the right direction for that heading into it. That's exactly what we've seen, by the way. We've seen a really strong bounce for trend for our version, but also in the SG trend index. So the year for the index wasn't terrible, actually, round trip, even though it was a really tough print through April. So to me, it's the more you distort trend to kind of create these bad outcomes. The good news is, if you stick with it, you actually tend to earn back that foregone compounding way faster than you'd expect than if you were just applying the average returns for the category.
And it's been well more used. That doesn't sound like good English, but right, people have loved it as a risk responder way more than long ball over the years because it's carried positively.
Yeah.
Right. It can have in an up year, it's up 4, 5, 6% or something. So they're like, cool.
Yeah.
But forgetting that every now and then you're going to have one of these nasty periods.
Yeah.
I would debate you that I think it's also things change. Like it didn't just snap back. It also changed the structure of what's happening. So in April, right, foreign non-US companies and everything were like, hey, we need to pull stuff in-house. We need to do a lot more in-country. And you started to see those markets rise. We need to secure commodities outside of the US structure. And you saw commodity markets start to rise.
Mm.
So part of me is like, what caused the drawdown can also push you into that new environment where the new trend, right? The drawdown itself caused a new trending environment of like the rules changed overnight. And now there's the new rules, which we need to adapt to.
Yeah. Kicked off a new regime. It's both of these theories are nice because they're untestable, which is, my favorite kind of theory. But the results are there, and it's not just isolated to this trend drawdown. If you pick the 10 worst trend drawdowns over the last decade, more or less ubiquitously, you saw a strong bounce. So there's something to it.
Yeah. And my non-scientific, non-testable thesis is trend works because it's so frustrating.
Sure.
Right.
No premium. Yeah.
Yeah. If it wasn't so frustrating and everyone was in it, maybe the trends wouldn't get in. But because it shakes so many people out,
yeah,
that it continues to work.
Yeah. And I think what you just said there is doubly true for long ball. There is, I mean, it's a pretty masochistic life calling to pursue long ball as a business, right? You're telling clients, hey, I'm going to generate what will appear to be a very frustrating return, but it's going to make your portfolio better. And they're going to say, well, when? I don't know. I really don't know when it's going to help you. But if you look at the very long term, it helps you not a little, but a lot. And we're going to do that every single day in a systematic way, waking up, probably saying, well, the portfolio is probably going to be down today. But when we're up, the magnitude of when we're going to be up is going to be so great that it's going to more than compensate for that whole period. And you're actually going to beat somebody who didn't do it at all. And you're going to have this insurance policy. And, here's a load of evidence for it, but it's going to be very frustrating to hold. Talk about no pain, no premium. The long vol premium is a paper that we wrote, which basically shows that for whatever reason, the right tail of convex instruments is more convex than is the left tail of, say, equities. And for us, that's a mispricing, right? Because you could, if you're a quant like myself, you could beta neutralize your long vol bet and make money. And that's true. You can. You can do that with a rolling put index. You really don't even need to be good at it. If you are good at it, it pays. But let's say you're bad at it and you just want to buy 5% out of the money puts. Yeah, you can pair that with an equity bet and make money. That's pretty remarkable that that can be, and that's
There's an
over a,
index that's been increasingly hard to beat, actually.
yeah, yeah.
Right, the Peapod index. Yeah.
Yeah, the P put in it, right. So these kind of silly passive indices that are protective, they look frustrating to hold, but once you realize that the reason they're frustrating is because you're leaning against the market, well, that's pretty easy. You can passively lean into the market and do that. And so that simple aha moment in construction, and by the way, we preach this gospel day in and day out, and we don't get ubiquitous implementation of it. So I think there's a lot of capacity left in this type of trading, and there's a pretty strong and resilient premium. We know who's on the other side of the trade, which is great, and they're not going away. Meaning, there's a lot of people who will be taking advantage of these dynamics from the short ball side, and they have mechanisms to try to make money as well. So there's a world in which they can make money in average return space, and we can make money for total portfolios, and that equation clears.
A bunch of stuff I got to unpack there. So one, who led me right into the question of who's on the other side of that trade?
Yeah. So when we buy a long ball instrument, if we're buying a VIX future, or if we're buying a call option on the VIX or an equity straddle, the obvious other side of that trade is going to be a vol risk premium harvester, somebody who's making money from the tendency of implied vols to be higher than realized vols. So if we buy, say, a call option on the front month of the VIX, there's going to be a plethora of capital that is rushing in to sell spot VIX because of this implied realized phenomenon, the penny in front of the steamroller strategy. And then there's going to be a lot of people who are non-economically buying the front month VIX to hedge their portfolios. And we could be part of that, right? And there's going to be people who want to play the difference between those two. So the people on the other side, and by the way, they're happy to do that because they get that positive average return. Now, by the way, that positive average return has a ton of equity beta. It just so turns out. It's a pro-cyclical strategy. And what I would propose is that if you were to beta adjust that vol risk premium strategy, you might see a negative residual for many implementations of it. But they're okay with that because they might say, I'm going to sell vol here. I'm going to sell an option. I'm going to sell the front month VIX or buy a put on the front month VIX. And when that strategy works against me, I'm going to be able to get out of the way, or I have enough kind of protective stuff to compensate me. That's the strategy. For us, we're long only vol. So we're on the exact opposite side of that. They're going to be there a full market cycle because they're collecting a risk premium. You only make money in a risk premium strategy if you're not too selective for when you're in it. Conversely, we will be long that. We'll have a few different levers we can pull to mitigate the negative carry without giving up convexity, and that's our skill. But ultimately, we know the other side of the trade there is not going away because they're making money. And the way that we make money too is that we take that negative return, or what appears to be a negative return, and we neutralize it using a different market, which is not the vol market, but the actual underlying equity market that you're protecting. So take the thing you're
the
protecting.
120, 100.
Yeah, the linear. So we take this non-linear right tail, we combine it with something that's linear and has a known left tail relative. So basically, we're buying the relative distribution of, we're long convexity, which means that fat right tail, and we're accepting on behalf of our clients the known left tail of equities, and we're betting that the residual of that right tail and left tail is going to be positive. And historically, it's been robustly positive. And clients can do that with us, where we buy the equities and the long vol. And most of our clients just say, you know what, give me the most capital efficient expression of that long vol, and we'll do the extra equity buying ourselves.
To set it back to my lotto philosophical experiment, like you're saying, buying it is better, right? You're not, when they come calling and like, hey, you've been getting these $5, you now have to pay it back. In your research, the buying has a premium.
Yeah, well, I would say that because most people would prefer to get the daily payment, it makes it much more competitive.
Builds the premium.
It's going to be way harder to outperform in the high average return negative skew strategy because that attracts way more capital. So we'd rather, meaning that a passive approach is much more likely to be the most efficient approach. Conversely, because the low frequency of payment positive skewer strategy is so frustrating to hold, we have a much we have much wider lanes to compete and be exceptional. So we
Or
can
said another way,
outperform.
like people,
Yeah.
it's so frustrating, like it's on sale.
Yeah.
People aren't going to pay up for it.
Yeah. And so because long volatility is such a frustrating distribution and frequency of return, we call it the frequency versus the magnitude problem. It's people want high frequency and they're willing to accept they're
Yeah.
willing to accept high frequency of returns and low magnitudes, and they're unwilling to wait for returns that have a low frequency of returns but a high magnitude. And so we have that systematic discipline to just harvest that tendency for people to eschew those type of returns. We can be positively skewed. And again, if you've done that construction really well, you really don't care when you get paid. You just know that when the wheels fall off the bus, it's going to work.
I think we had a blog post, which was taller heads and fatter tails, right? Basically, they want taller heads. They want more of the smaller thing
Right.
in exchange for these fatter tails. I wanted you to say, oh, Warren Buffett's on the other side of that trade, or like
Right.
XYZ. But
Yeah,
right, a lot of these
individual.
big insurance companies and all that are doing that all day, every day, right? That's like just a line item for them of like, we make 7% a year selling this volatility. And
Yeah.
if it crashes, so be it. We have this super long time horizon
Yeah. I
and
think
whatnot.
when you see things like the covered call phenomenon and the structured product writing, that's clearly somebody who's on the other side as well. If we're kind of not naming names, but naming
Yeah.
classes of people who would be on the other side, those are clearly um, distortive to this vol dynamic, and we're very happy to be on the other side of that.
As you mentioned that, do you think that's a blow up problem? You think there can that blow up, or is it just going to peter out because people will eventually be like, I keep doing these structured products and the market's up 20 and I only make 8, or the market was down 30 and I lost 30, right? It's the bigger problem with some of the buffered notes and whatnot. But
Yeah, like
what,
most
a
things,
quick aside, what are your thoughts on all that stuff?
predicting a blow up's hard. You need a few factors to happen at the same time, but I think it's good dry tender for sure. There's a lot of frustration. It begins with frustration, and then it begins with smaller returns, and then that leads to smaller returns because people learn about this. What appears to be a free money trap, and then there's a negative skew event, and that creates fear, which leads to more capital being withdrawn from those strategies, which leads to this reflexive cycle of people getting stopped out of the trade. But that's one way it could end. And that's the quote unquote blow up. That's like in Volmageddon. That's what we saw with the short VIX exposure.
Yeah.
That was February of 2018. There was a rush to the exits. That's great for our process, by the way. But it could just as easily end with a very long and frustrating
A
period for
whimper.
something that used to work very well and people rebalance, calmly away from it. It doesn't always have to crescendo into if it did have to crescendo into a blow up, then what we do would be much easier,
Yeah.
because
Right.
yeah,
More
because
blowups, less whimpers.
things things don't have to blow up. There has to be the right combination of leverage and over reliance on an outcome, and then you get that kind of sweet spot of a rush to the exits. Like
But it
for
seems
instance,
like people think of that the same way on that side, right? Of like, hey, if I'm
yeah,
earning this income and reducing my beta
yeah,
by doing it, let's increase both.
yes,
Yeah, which seems like a problem to me, but I have trouble thinking of that philosophically of like if the problem's just you, everyone gets called out,
yeah.
right? You're not going to have like a cascading liquidity cascade issue.
Oh, and I think that's right. We have a chart that we use a lot, which is just showing rolling returns on equity markets, excess of cash going back a century. And right now we're in the 99th percentile of that observation. And you look at that and you go, wow, I should fade equities, right? Not necessarily, right? Because we've been at this level of excess return. So we look at 10, 15, 20-year periods. We've been at this kind of level of excessive cash returns over those kind of periods twice in the last century. Once was a tech bubble. Okay. Yeah. That in that case, the correct policy would have been to run away from equities and probably hide under your desk. What we do would have been very great for that period. Um, Conversely, the other time was a post World War II reconstruction period, and
Right.
markets spent a decade crashing through all time highs. More or less without fail, without break. And so, with a sample of two,
Yeah.
there was exact opposite protocol was called for. So,
Even the tech bubble, right? Famously, people say like it was overpriced in '94, and
yeah,
Nasdaq still went up 300% until '99 or whatever.
right, right. And yeah, if you called the 1929 crash, well, 1928 was, forget what that, you had something like an 80% run in the 18, 15 months before the crash. And so all of these, obvious rear view mirror points to jump off are not so obvious in the moment. But I think it goes beyond that. What it is that just because things are at an extreme level or you've identified a pocket of leverage that you think is unsustainable, I think the US fiscal situation has been deemed unsustainable for the better part of this market cycle. And here we are. And so rather than take a directional bet, to us, it's about combining pro-cyclical and defensive bets with enough asymmetry where you can do both at the same time all the time. And that's and then you're totally agnostic to whether you get a post World War II or a tech bubble in this 99% observation, you shouldn't care.
Right. I always go back, like, how much value can we put in 100 years ago or even 20 years ago? And like, to me, today, the world, right? Who was it? Eisenhower said, beware of the military industrial complex.
Hmm.
Like, beware of the financial industrial complex, right? All their job is night and day is to keep this thing moving,
Mm-hmm.
right? Like, there's trillions and trillions of dollars on that side to keep this thing moving versus a handful of us who benefit if and when there's a crash.
Yeah.
So
Yeah. And you never,
don't fight the tape.
predicting
You
themes
know,
is
there's tons of
nearly
adages there.
it's nearly impossible to predict these themes. I mean, I think January of 21 was a real watershed moment where we realized, this theme of degeneracy actually has weight. This GameStop phenomenon.
Oh, yeah,
It's
yeah.
funny to muse on, but if you actually look at quant portfolios that favor, say, heavily shorted companies, there's been a structural change in the performance of those portfolios versus the previous 20 years. Like that event had a systemic change in the market, and then we've seen a manifestation of that through betting markets and Apollo market. And now they call them prediction markets. They're not even betting markets anymore. They
Yeah.
serve a social utility. We predict popes and game outcomes and Fed chairs through betting markets. And the volume that goes through these markets is non-trivial, right?
Yeah.
And so now we have to incorporate into our models, what about a whole class of investors who are intentionally making uninformed bets? Like, how do you model that
Hmm.
into a market cycle? I don't really know, but I don't
That
think that.
then inform, right? People are using prediction market data in their models that are informed bets. So yeah, hey, you're using uninformed bets to inform bets.
Right.
Square that.
Yeah. And so, you can think through that and make a bet on a side of the equation. I don't, by the way, my bias is that doesn't make the world less fragile,
Hmm.
but ultimately that's now a meaningful portion. That's a distortive force in the market that didn't used to be there.
Will you guys look at using those for certain things? Like, there's certain convexity plays in there, I think. Like, I
Yeah, I
haven't
think
dove
so.
into that, but
I'd say the closest analog I can find in our markets would be something like a zero DTE, like a 0-day
yeah.
option. The volume there can be very different in its composition to, say, like a front month VIX future. You don't really see too much retail flow in a front month VIX future, but you'd see a lot of more retail flow in something like a 0-day option. So we aren't necessarily trading that instrument in
It'd
high
be
volume.
interesting if they're like, make me a market on there'll be a crash in the next 1, 2, 3, 5, whatever. Like, you'll have a whole stretch of years.
Yeah, and people well, and then you see banks making markets and hedging those trades through the the instrument they have at their disposal. So what we've seen is, a lot more opportunities in short-dated equity options, 3 to
Right.
5 days. You don't have to be 0 days, but, there's these feedback loops through more gamma-oriented trades, which is great. If we can own cheaper gamma that's more mispriced, that's great for our process. So some of our more innovative sleeves in our portfolio are taking advantage of those phenomena through, fixed downside long gamma trades. And that's great. So
And how do you view that? The portfolio is like always building, right?
yeah,
Especially a long ball book is building.
yep.
So it's not just like, oh, we put on this trade every Tuesday. You can grab stuff at a discount. You can warehouse risk. So how do you think about that, and how does that work?
Yeah, for a good long vol process, first off, when you build a long vol portfolio, you kind of have to be building a portfolio for things that have happened and haven't happened. That's a unique feature. Every other manager, I think, has the excuse in a major market event. Well, that's never happened before. You
Hmm.
can't really say that as a long ball manager. If
Yeah. That
1987
was what
happens
you're here for.
tomorrow, yeah, we're there for that event, right?
Yeah.
So in that respect, we have to have a portion of the portfolio that's always on, and that's the hardest part of the portfolio because it tends to be the most expensive. Meaning, we're rain or shine, we are protected, And that's a big
Yeah.
part of our risk. That's where most of the bleed's going to come from, the bleed that you'd observe. Then we have dynamic parts of the portfolio that are brave enough to market time. The only reason we have that bravery is because we have the portion that's always on. So you're going to have the dynamic.
You can afford to be wrong, basically.
Yeah. And then if you do those two things well, if you have a good long only market timing mechanism, you have a good always on mechanism, we believe we do. That's pretty minimal negative carry. Well, then you can do really exciting research where you're like, well, can we buy really short dated gamma that's super explosive? And do we have a signal or alpha approach to buying that at a cheap level that the market really underappreciates? You know, and some of these signals that we've seen have been really fascinating. So we've been able to hold positive expectancy gamma, which is kind of the holy grail of hedging.
Yeah.
I'll give you an example. When these banks make the market for options, they have to sell options to the street. So if there's a exogenous catalyst, it could be a bad economic print or anything, and there's an overwhelming bid from the street to go buy options. Well, the banks will make that market. That's their job, and they're going to sell those options. They may take on a net short profile to the market, a negative gamma profile. They have to hedge that out pretty quickly. If you have a good mousetrap to identify when they take on that risk positioning, you can actually basically take advantage of a behavior they're going to have to do. Right.
Yeah.
Now,
It
doing that
comes back to the
requires
GameStop thing of the market makers had to keep buying GameStop
correct.
because they kept selling long out of the money calls to
Right.
punters. Yeah.
Right. So if you have the right feeds and you have the right way to process that data, you can actually, with a really good degree of accuracy, predict when that's going to happen before it happens or as it's happening. And so you can actually get in front of that trade. And so that would be kind of, you're saying, how do we think about growing the portfolio is, can we find sub strategies like that that'll give us really punchy convexity? So we'll go in right there and buy a 3 days to expiry straddle. By the way, buying a straddle that expires in 3 days, usually not a good idea because it's going to be very expensive and the crisis usually doesn't happen. But if you do it with that kind of filter, then all of a sudden it turns into you get your money back 90% of the time and you had that gamma. And you're like, well, great. And now it's a really good trade.
Sign me up.
Yeah. So that's what, when we do exciting research, it's really, first off, making those, I'd say the lettuce of our salad just better and better, meaning having the always on, having that market timing piece good. And then, yeah, if we can overlay these kind of really explosive gamma strategies or, protecting ourselves against deleveraging risk, that's where we get better and better. So every single day we'll review, a series of different research projects that are looking at, just amazing techniques to try to win that game. It's fun.
And that's still rooted in S&P exposure, U.S. stock market exposure?
It's
like, could you be like, there's huge convexity by buying this uranium mine or something, right? Something like that.
We're equity centric, but we're not dogmatically equity only. So dynamic convexity as it exists today happens to be just equities, but that's not a risk constraint, meaning that some of our research is pulling us into things like CDS and may eventually pull us into some rates and commodity vol. We're open-minded to it.
Yeah.
I would be shocked if in a year or 2 years from now we had zero non-equity long vol in there because there are just some really attractive lead lags. What we need to be mindful of, though, is not forgetting the mission. The mission here isn't to make money. The mission here is to protect an equity book. So we need to make sure that what we're adding isn't going to add pesky bleed to a phenomenon that isn't tied to equity markets. Because now the mission is to protect equity books. We can't say, oh, well, your equity insurance policy lost more money than we thought because we were, trying to pursue convexity in commodities. Well, that's not an acceptable form of bleed for a portfolio.
We're not willing to take that basis risk, right, investor.
So if we're going to do it, it has to be something that really has a direct economic loop to procyclicality and being on the other side of that asymmetrically. But there are opportunities that I think will meet that criteria, and I expect that we'll grow into those areas selectively.
From my seat, seeing a lot of these cross asset vol, that's where people have done well over the last couple of years.
Yep.
Instead of equity vol. Equity vol's been tough. Flip that on its head of a lot of your, I don't know, maybe the institutional investors aren't as concentrated, right? But a lot of portfolios have become more and more concentrated on AI stocks, NVIDIA, whatever. Like, how do you work that in? In theory, NVIDIA crashes, the whole market's coming down. But that's also a basis risk, right? It could sell off and the S&P holds up rather well, or you have like right, your investors are kind of long or short the dispersion trade. They kind of have this dispersion trade on, they don't know, and you're not necessarily hedging against that.
Yep.
So do you guys think about that, or you're just saying, hey, we're looking to hedge a broad market decline?
But yeah, single name vol is a really interesting area of opportunity for us because, as you mentioned, there can be these idiosyncratic dumps in individual names where the implied vol really explodes there, but at the S&P level, it's just tame. Right, and year to date is a decent example. I think these some of these high flying names are down in the realm of 10 to 17%. You have a relatively flat index return, right?
Yeah.
And so it's really good opportunity. It's dispersion trades. It's great for dispersion trades, and we do that elsewhere in our platform. By the way, we have a dispersion alpha portfolio, so we acknowledge that as. But I wouldn't call that a form of explicit long vol. Within our long vol program, we would be looking just alongside of that trade. Can we own some of these single names? I think the answer is yes. And what's really changed over the last few years that wasn't true a few years ago is just the amount of volume flowing through these single name balls. And so we can really do things. We can apply a lot of the models that we have successfully applied at the index level at the single stock level. And now, because it's a single stock, a lot of the fundamental indicators that we have become much more relevant. So we can actually have a much more specific way to apply fundamental insights to whether or not a vol is cheap. So yeah, it's an area of extremely active research for us, and the increased volume just means that now we can do
Yeah.
that at greater scale and greater impact to the portfolio. So I think
And
single
then I
name
like
vol
how
is
you're not necessarily making it a dispersion trade. Seems like everyone else in the vol space is like, oh, if I need single name, I need to pair it with short index vol,
yeah.
right? And have this dispersion trade on. It's like,
Well, yeah, that's the siren song of long vol investing is that you can sell enough vol somewhere to mitigate your bleed. And the issue with that is that that's exactly that's what we're trying to take advantage of is the belief that you can sell vol all the time and not lose money when the wheels fall off.
yeah, back to my
Categorically,
thesis.
yeah,
Like at
yeah,
some point, you just are on both sides of your own trade.
yeah.
You're just
Yeah.
trading against each other.
Yeah, it's
You're
counter
selling.
mandate to do that. So for us, we aren't really tempted. We're a long only vol in our long vol program for that reason. And the overwhelming temptation, the siren song that people give into to do that is part of what feeds the premium. Every single crisis doesn't there will always be a long vol manager who loses a lot of money. One of them. It's like
Yeah.
it's a truism of markets. And invariably they had some sort of curve trade or dispersion-esque trade that didn't go their way. And it's exactly the dynamics you're talking about, where, I'm going to sell the 6-month vol contract. I'm going to buy the first month. I'm going to do it in a ratio that's always worked.
Yeah.
And
Look at it.
then,
Look at the back test.
yeah, lo and behold, there's a snap election 6 months in the future, and that contract moves way more than it should. And lo and behold, your convexity program's down when it needed to be up.
Yeah. See amaranth and natural gas spreads. Right. Which are just a lot of people just got hit on that this week. I want to finish with two different things, visuals and your Mount Rushmore of metaphor. So let's do the visuals first. So you guys, and three things and a little news bulletin at the end. So I've been to a few conferences with you, seen you speak, seen you have some great slides. We don't really like to do slideshows on here, but if you have the ability there, just pull up a couple of your favorites.
Sure.
And we'll talk to them real quick. Show them to those on YouTube. If you're listening on Spotify, head on over to YouTube if you want to see them, or we'll try and explain them as well. So while you're pulling this up, who does this? You got a whole team there, or how does it go from idea to looking like a cool chart?
I do it old school. I write a picture down on Post-it, and my team is amazing at this. I have a particularly talented kind of squad of two of us, and we crank these out. So
Love it.
it's a little factory, but I do it very old school. Have an idea, literally draw it, and then we get the data, and then we create the slides. So but we'll make a couple of
We
these
got
a
to get
week.
you some AI tools to
Yeah,
spice up that drawing component.
exactly. But yeah, this is one of the more popular ones that I mentioned earlier. You're just looking at basically periods that define people's investing careers, 10, 15, 20-year horizons. And right now we're at the 99th percentile of these rolling observations. And this is excess of cash, right? And this is
Hmm.
the point that I was making earlier. You see in the tech bubble, we were here-ish, and we spent 15 years below high water mark and having a really tough time. Conversely, we got here in the late 50s as well, and we stayed there for a decade plus, right? And the point of this slide is just to say we're in a two-tailed distribution, and just because valuations are stretched, just because we're a long ball manager doesn't mean that we're saying it's a really good time to embrace what we do and run away from the thing that's made you money to this point. It could very well be the case that we have a decade of exceptional equity returns. So we really recommend that people find a way to embrace the left and right tail at the same time.
It could be argued, right? Late 90s vol was increasing with equity prices too, right? Like
That's
at
right.
some point it gets so crazy that vol's increasing. You got spot up, vol up.
Yeah, that's right. Yeah, and just going down the visual, the Rushmore. Well, actually, Rushmore is a different question of yours, but
Yeah. Yeah. Give me the next one.
this one is uh,
Oh
this is
yeah.
funny. We
Love this one.
make a lot of kind of, I'd say, mathematically oriented slides, and sometimes just squiggles on. This one was genuinely a drawing, talking about the origin, but the different ways equities can lose money, and the different way you forego compounding. Um, Scenario one is the least frequent, but the most important to protect against: the '87, the GFC, the COVID. This is really what we're primarily built for, because if you don't have something to save your tail here, your equity portfolio can forego decades of compounding,
Yeah. Like
depending on
lost
how quick you
decade,
move.
all that sort of talk is what
Yeah,
happens there.
yeah, that's when it happens. The second
And
most, which is
worse, like you're institutional investors, but if you're an individual or a family office and that's when you need the cash for something,
yeah,
right? That's a bigger problem too.
yeah. So that's the most important to protect against. It's the least frequent though, so you have to have this discipline. You have to have a way to do that all the time. The second one is the second most frustrating and impactful, and that's going to be the slow bleed, the erosion of portfolio value. And this is where the slow twitch muscle that we talked about comes through. So directional macro
2022,
trend
basically.
following 22 tech bubble. Yeah. And then the mini crisis is one that very few people talk about. They don't talk about it because it's the hardest to protect against. We do, if I may say so, I think a uniquely good job of doing this, but um, this is the type of event where you gap down really quickly and you just don't come back right away. And August of 2015 was this pesky Chinese deval that structurally changed the market. We gapped down 10 to 12%, stayed there. Um, the US debt downgrade is another one. That was a big, we ended up recovering in both cases. In the case of 2018, we actually saw another decline in Q4.
Now
But
nobody cares. We'd just be like government shut down for 4 months.
right.
No downgrade, nothing.
Right. So now, those three events are the most impactful. And then you have these V shapes, and the V shapes are the ones like the August 24, like the April of 2025, the tariff tantrum.
And you're kind of ordered in frequency here and how often they happen.
Yeah. Well, in frequency, but also in terms of what's the most
Painful.
painful and important. Yeah. So this is going to be the V shape here is going to be the most psychologically damaging, but the least impactful,
Mm.
alongside choppy markets, right? Because by definition, you've gotten back your value. So that's that. This is the type of thing where we're happy to run a process that has accrued meaningful gains through the trough of this chart. But if it's going to sacrifice some returns in an immediate recovery, so in the case of the tariff tantrum, we literally had a 12% upside intraday reversal on the S&P. We're going to give back some gains. There's no world in
Yeah.
which we don't, right? Now, you could have just, if you emptied the coffers every single day, meaning if you just monetized your hedging benefit every single day, you don't have that phenomenon, but you also aren't protected in scenario one, right?
Yeah.
Because you just have to keep rebuying vol at its prevailing level. It gets very expensive late in a crisis. So we make a choice, and that's our choice. And then these choppy range bound markets, this is where I'd say, systematic macro trend can do well here. Depends on how it manifests. If it's too choppy, then it does poorly. But if it's kind of ebbs and flows, then it does great. But for us, I'd say systematic macro, risk premia, alt risk premia are the main ingredient here. So you have this kind of combination of strategies that tend to work well together: convexity, directional macro and trend following, and then this kind of risk premia or systematic macro. That's the 1, 2, 3 punch of our platform for that reason. Because basically,
And
our mission's pretty easy. It's identify the periods in which equities disappoint you and build active risks that won't disappoint you. And if you do that well enough, then you should end up with a portfolio that compounds better than equities by themselves.
do you think it's over, like, probably I've said it before on this pod, like there's an infinite number of paths to some S&P drawdown, but maybe not, right? They're going to somewhat resemble one of these.
Yeah, of course. The reason these are squiggles on a line and not specific historical events is because we don't overfit. We just try to
Yeah.
say, well, if this shape of crisis happens, what do the off ramps look like, and what gets elevated? In the case of a chaotic decline, it makes sense that things like option premium would expand, so implied vol is a good place to be. In
Yeah.
the case of a slow decline, it makes sense that you want an algorithm that will identify that trend and join it. So if you can break these down into their core parts, then you can build an engine to extract the other side of that.
And realizing there'll be hundreds of paths within each of these looks,
Yeah.
right? This is the,
Yeah. And what's nice is at no part of our process do we say, well, geez, what's the frequency of that? We don't, there's no normative lens as to how often these things should happen or even how big they should be. It's more about building ingredients that do well if they occur.
yeah.
And so if
Right.
markets just want to dance up and to the right ad infinitum, we're at peace with that. We actually are, because most of our clients are doing that too.
Yeah. Yeah, exactly.
So
Good
for us,
times.
it's really about building something that's a barbell that's not going to cost you while you're waiting for that to happen in the total
And the
portfolio.
Stanford economy is booming because all those guys are long. Yeah. All right.
And and then this chart is basically the top 3 things that you should be worried about if you're trying to maximize compounding, which is maximize diversification, which, uncorrelated is great. It's nice to perform randomly relative to equities. It's better to perform inversely relative to equities in terms of what you're adding to the portfolio. You have to do that in a capital efficient way. Going back to our earlier discussion, if you can't stack this on top of equities, or if you need to chew up a lot of balance sheet to defend yourself, then it's just probably not going to be the right. You're going to forego too much beta to make the defense worth it. Okay, so you need to be very capital efficient, and then if you do those 2 things well, and only if, then you can rebalance along that journey. And I also like this paper because it's a little bit of a opportunity for people to hop on, read our white papers. But yeah, that's there's a lot more slides behind this, as you know. And we
Yeah.
have other
Do you have the
exhibits where
rebalancing one handy or no? We can skip that.
oh
That's
yeah, of course.
inside the convexity rebalancing.
Yeah, the Convexity Rebalancing Act. So, and this one was really fun to do. I mean, you can see the plethora of slides here that we go through with clients. It can be a little dizzying, but let me just here we go. So I'm sure you're gonna okay. Yeah, there it. Oh, we just got there. So yeah, this is the Convexity Rebalancing Act, as you mentioned, which
Yes.
is we talked about calendar based, which is time based rebalancing, more path independent, and then we have threshold based, which is the tempting one. Turns out to be much worse on average, and even in the extremes. And then we combined the 2, which is kind of interesting as well. But in the paper, we looked at basically thousands of permutations of different types of programs categorized into these broad groups. And lo and behold, calendar based was way more path independent. The average outcome was way higher than it was for this chunkier threshold based rebalancing. And I think most interestingly,
Higher floor. It's
yeah,
what you're
higher
after
floor.
there
The
too.
max of one is basically the min of the other. You're pretty close to
Yeah.
that. But also, if you look within the paper, we also go into all the different trials that we ran. It turns out that whether you rebalance monthly, every 2 weeks, every 4 weeks, it didn't make a big difference. So you
Huh.
didn't have to get it exactly. It's always nice when you don't have to get it exactly right. It usually means you have a pretty good model. Conversely, with threshold based, it would be you would change one parameter a little bit
Yeah.
imperceptibly, and it would have a massive consequence.
Because you just missed the
You just missed it.
April 7th by, right?
Right.
You were at 82x versus 83x.
Right. And the purple actually has a funny story here. So the purple was we presented the green and blue to a client of ours, a sovereign wealth client, and they said, "This is great. We're still going to do threshold."
Huh.
And I said, "Okay, I'm only moderately offended. Why would you do that given this evidence?" And their response was actually pretty insightful. They said, well, if the market's down 50 and you're up 80, I don't care what data you show me. If
I'm doing it.
I'm going to pull the plug. So I said, that makes a lot of sense, actually.
Yeah.
So instead, let's do this. If you're going to sin a little, to borrow from my colleagues at AQR, then let's do a calendar-based program where every, let's say every month or every, quarter, we'll knock these two things back into shape. And then if you as a client want to pull the plug, just do that through redemption,
Yeah.
And so the purple combines both calendar and threshold programs. The bad news is you still are hyperpath dependent. The good news is your average outcome now looks a lot like the calendar.
Yeah.
So now you can actually sin a little, and you can actually have a decent likelihood that you'll do better than just doing the calendar based program if you nail it. So yeah, and now you can appease the CIO and the board while adhering to some sort of I'd say rigor in terms of the empirics.
Love it. We'll go off the screen and I'll
Yeah.
get you. Thank you for those. But it's interesting. So it starts with the research. You're not coming up with the drawing and then make that and then fitting the research. You're doing the research and then what's a good visual to relay that information?
Yeah, a lot of the times it's something that, I think a lot of paper writing goes like this. You're trying to get across an idea in a meeting, and it's something that you know is true because you've done the quantitative work behind it. You've done the actual empirics behind it. And then you find it really difficult to express that in a way
Mm,
that gets across in the meeting. You're like, well, I never want that to happen again.
yeah. I need a better
So
visual.
instead of having a bad meeting, I'm going to have this exhibit that summarizes all this work. And that's usually the impetus for every good chart that we've made.
Moving on, you've used a couple of them already. The F1. I think you mentioned some salad earlier. So
Oh yeah.
give me your Mount Rushmore of your favorite metaphors you use to describe the risk responders or basically everything you do.
I think the
You
F1
can
car
add one
is
too if you
the
want.
best.
So go.
Yes, you wanna not just add good brakes, but you need to drive faster as well. That's gotta be on the Mount Rushmore. I would say, yeah, you mentioned soup or salad. We wrote a paper in January of, I think it was 23, called Convexity, Correlation, and Compounding, and within we talked about the total portfolio approach, which is now ubiquitously discussed. And at the time, it was a bit more, I'd say, niche. The
Mm,
NZ Super was doing it, Future Fund was doing it, but it wasn't really a tidal wave quite yet. Now I'd say it really is. But yeah, at the time, it was hard to explain to people what the total portfolio approach was. And so we use this metaphor of portfolio soup versus portfolio salad. And in a traditional strategic asset allocation, you effectively have this portfolio salad where you have a salad bowl, it's full, you have the lettuce of your salad, probably your equity beta, and you have all these accoutrements that you mix in, and every single bite you get is a vertical cross section of that salad. And if you want to add something, you have to remove something else.
mm.
And you try to get the right ratios to have the best tasting salad and being nutritious, and you have all these goals. Great. That's the
Gotta have
siloed
croutons.
strategic asset allocation approach. Conversely, the total portfolio approach is like a soup with a really big cauldron and this kind of base of liquid and all these ingredients. Well, the nice thing about soup is that you have this big bowl, you can add more liquid, like leverage, you can add different ingredients, which would be diversifying strategies or things that make that liquid taste better. But everything you add to the soup, it touches everything else. So you
Becomes
only add
something
things
new.
that make the whole thing taste better. But
Mm,
but convexity is like salt, So there's two metaphors here. Two metaphors for one. Convexity is like salt. It doesn't taste very good on its own, but it makes everything else taste better. And so if you have the portfolio soup, you're much more likely to embrace salt because you're just going to sprinkle it in the soup. And it's funny, one of my colleagues said that he puts salt in his salad, and I was like
like
ready to
what?
report him to the FBI. Um, but what we say is, like, yes, if you really think about it in the total portfolio context, where you have one big cauldron of soup that you're constantly mixing, and you're adding some things, but ultimately, when you add something, you don't have to take anything out.
Mm,
It's this integration of exposures. It's this stacking of capabilities. When you add salt to a soup, you do it because it makes everything else taste better. And how much is the right amount? Well, just keep adding until you get it right.
yeah.
And so that metaphor helps us because I genuinely think the people who will embrace what we do the best come at it with a total portfolio mindset.
One slurp. To
Yeah.
me, you actually can go above. This gets into leverage. I'm mixing metaphors, but in the salad, I can go above the bowl's edge.
Yeah.
The soup, I can only get to the bowl's end. But I get you.
Some sort
Uh,
of tension, right?
all right, that's two. What else you got?
So yeah, I'd say those two, like the sumo wrestling metaphor, is a common one as well that we used in a recent paper. But it's just a reference to effectively the difference between kinetic energy and potential energy in
Mm,
markets. And oftentimes, and this is just a non-over reliance on backtests when it comes to convexity, right? You create a backtest that looks unattractive, but then at the same time you say you're trying to hedge something that hasn't happened yet. Right. And so you can't overly penalize what looks like a tough back test when you're really trying to protect something that hasn't happened in the future. And so the metaphor we use is that it's like two big sumo wrestlers deadlocked in a ring. And if you're an unknowledgeable observer, you might say, well, there's nothing going on. All
yeah.
right. If you're an knowledgeable observer, you say, well, this is two massive forces deadlocked in the doyo, which is the ring. They're deadlocked in this doyo, and I know eventually, because it's exhausting to wrestle, that it's going to break. I don't know how it's going to break. I don't know who's going to win, but I know it's going to be chaotic when it does. Okay. So I'm going to make a little bet that that happens all the time.
Mm.
And by the way, most of the time it won't happen. From second to second, the match won't end, but eventually it will. I know it will. And it will reset into a new match. So that the sumo wrestler, the metaphor is markets, right? You should always be betting on the end of the match, even from the first second of the match, because sometimes the matches can last half a second. Sometimes they can last a couple of minutes.
Did you go to some when you were in
I
Japan?
did. Yeah, that was the
Nice.
impetus for the paper from my perspectives. I actually had gone to a few dojos. It's a really interesting experience.
And you mentioned fast twitch, slow twitch, so we won't touch that one. What's your last one? You were recently in Germany, came up with a new one.
Oh yeah, that was great. That was a SIBO conference in Munich, and it was Beer Fest. There was a classic 2006 movie called Beer Fest, and in it there's this famed beer stein, which is the glass boot or Das Boot as they call it in the movie.
Das Boot.
Yeah, and the game is simple. You chug a beer full of boot a boot full of beer as quickly as you can. Okay, and well, the thing is, as you chug the boot, and the boot's a weird shape, you get this bubble, this abscess of air forming in the toe. And then eventually that air bubble needs to transfer from the toe to the main funnel. When it does, it creates this gurgling effect. You tend to get overwhelmed. Okay. And that's a decent metaphor for markets, okay, or equity vol pricing, where people like now, they'll see something in markets that I think is overvalued or potentially bubbly.
They
They
see the
tend to
bubble at
yeah,
the end of the boot.
yeah. And so they're chugging and seeing the bubble forming, and they could do a host of things to prepare today for that bubble to eventually reach the main funnel of the boot. But instead, their policy is to just react when that bubble does manifest as a problem. The issue is that it may manifest in a way that's too overwhelming to react in the moment. And so if you
Mm.
don't do that preparatory work, if you don't have a plan, it's unlikely you're going to navigate that bubble very well.
And beer all over your face. What's the outcome?
Yeah, the outcome is, yeah, you fail the boot chug. You end up underwater. In this case, quite literally under beer, you end up looking back on that period, saying, "Well, geez, if I had done some sort of hedging activity, if I had a plan for the bubble, I probably would have had a better time, even if it slowed down my chug, even if it was
Yeah.
just drinking a little bit slower at that point in time." Right?
The angle of the boot. I got to try it now. Love it. Those are great. Keep coming up with some new ones. You're probably going to get strained on finding new ones, but
That's fun. Yeah, I mean, I think traveling helps because you go somewhere new in the world and you see some sort of interesting cultural unique item like sumo wrestling or like F1 cars, right? And you kind of see that these unique trade-offs they make. When somebody's really exceptional at a craft or something, they usually make they make a choice that appears unintuitive. And I think that we have a parallels to that in the long ball space. It appears pretty unintuitive what we're doing day in and day out. But when you see why we do it, it all of a sudden makes sense. And so you try to find those moments in nature, and then they make great metaphors.
yeah, I've talked to advisors before, and they're like, "Oh, well, you don't see people just walking around with parachutes on at the airport." Right. If the plane's going down, they hand out the parachutes and you're fine. Like, when the plane's going down. No, they don't hand out the parachutes on the plane. I don't. Yeah.
I hope they don't have to learn that one in real life. Yeah.
Yeah. And, or they say the life vest, right? You're like, everyone's not walking around downtown waiting for a flood with a life vest on.
Yeah. Well, what I would say is that, you should listen to the announcement at the beginning of the flight, because everybody puts on their own mask first.
Yes. Yeah. Love it. We'll finish. You shared some, you guys got some news to share?
Yeah. It's
fellow
been,
long ball space.
Yeah, we put out an announcement in December, and just confirmed this week, kind of final signed agreement, but we're moving forward with acquisition of a European alternatives firm. It's the firm is part of LGT, which is kind of one of the premier Switzerland-based private equity firms. They have had a fantastic internal QIS hedge fund team that runs really similar strategies to the ones we run. They run a systematic long vol and a systematic risk premia or systematic macro strategy as well. So those two strategies, they just fit perfectly into our view of the world. They're negatively or lowly correlated, very capital efficient, and they are very liquid to be rebalanced alongside what we want to do. So, going back to all those exhibits, we think they're just going to make us better at all those things in a way that we can acquire a decade plus of experience and some great strategies, start finding ways to integrate that inside what we do. So, a lot of what we do, just very simple, is just like being a chef, and you reach in the pantry, the better ingredients you have, the better dishes you can make. If you have a good framework,
the better soups you can make.
there you go, better soup.
You're not making dishes, you're making soups.
And yeah, for us, it really comes down to ingredients at the end of the day. For us, we're always on the lookout for new strategies, new research, but sometimes it makes sense to kind of make I'd say a more nonlinear jump into
buy versus build. Yeah.
Yeah, into finding these ingredients that are well established, well proven, and overlaying them on top of what we do. Yeah, the main benefit here. Yeah, go on.
Will that open you up to outside hedge funds as well, inside of their portfolio, or it's just their internal stuff?
Just their internal stuff. So we're going to continue to be 100% the investment manager for what we do across our platform. So no external hedge funds, and we're hiring that team actually as full-time employees. We're even bringing on some partners to OneRiver through it.
Love it. Awesome. Yeah. We know those guys, so that's a good fit. All right, we've taken up way too much of your time. Thank you, Patrick.
No, thank you for having me. Appreciate it.
Keep up the good work. Keep trying to convince everyone this is a good idea, because we believe it over on our side. One day we'll be proven right.
Amen. Thank you so much for having me.
And if not, we've got the equity side. We're fine.
Yeah, there you go. Awesome. Yeah. Thanks so much, Jeff. Appreciate it.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.